Something I'm noticing in the far from expiration broken wing butterfly pricing is that the at-the-money broken wing butterfly and a 200 point below the money upper long broken wing butterfly are priced almost the same in an overextended short-term market. It seems like a no-brainer to be a few hundred points lower than the current levels, as any down move won't add much pressure to the position. And pricing-wise, it doesn't seem like much of a giveaway. I understand that every decision is a trade-off. So what's my trade-off by choosing the below the money rather than the at the money in the long strike? So this brings up a lot of interesting topics, and I'll just talk about what sort of comes to mind here. So just to come up here, this is an example of, and I'm 79 days to expiration. That's fine, right? But our standard V14 is going to look like this. Hold on a second.
Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
I want to go here. I want to do start new trade. I want to go to at the money. I want to do 1, 2, 3, 4, 5. Our setup here is we're positive 2.17 delta. We are costing us what, like whatever this pull down is here, like you have to guess what that number is. It's like $440, right? Actually, I can see it here, right? It's costing 440 on the upper expiration line, 5040 broken wing butterfly, standard V14 entry. So a lot of times you might even get better pricing below the market. This is the case here. If I go further below the market, I get better pricing. Particularly in any trade where your expiration line up here is 0. If you go further back, it's probably still going to be 0, or you could reconfigure it so that it is 0. The pricing of your butterfly is due to, especially if they're all out of the money, it's all extrinsic value, right? It's like, how much am I getting when I sell these versus how much am I paying when I buy those? And that's what's going to determine where this level is. If I go to the actual example here, this butterfly is actually cheaper than, or better price. So it's costs about $110 or $150 rather than $440. So it's actually a better price. The challenge is, one of the main challenges is, well, what are you going to do with this? It's like, well, first of all, I'd like to point out, pricing isn't always equivalent on something that's 200 points below the market as it is at the money. Sometimes it is, sometimes it isn't. In the recent implied volatility market, much of the time it's pretty similar. Okay, so if I do create this trading strategy with the assumption that it's going to be the same as it was, that's not necessarily true, right? It's not necessarily true like forever, right? And I have to keep that in mind. Things might change. The second thing is, you got two dynamics when you're trading. You got, yeah, I don't want to lose or draw down if one thing happens. And that's great. It's like, I can give you, if you want to trade where you don't lose money, I can provide you with a trade you won't lose money 99% of the time. It's at high risk at some point, it's going to lose a ton of money, but it won't lose money 99% of the time. I can provide you with that. I have rules for trades like that. But the trade doesn't make any money either, right? So I think a lot of us are in this business to make money, not just to not lose money. I mean, why bother even being in the market if all you're doing is not losing money? Doesn't make any sense. So my first question when I run into something like this is, what are you going to do to make money? A vast majority of your trades, the SPX is not going to be down 200 points and hang there. Vast majority of your trades, the SPX is not going to stay where it is. The vast majority of trades, it's going to be up. So how am I going to make money? If you get 200 points below the money, if you look at the V14 rules, we have our up adjustments, right? But if I look at the context of the rules, I have to have -1 delta. It's pretty easy or common to produce -1 delta, anywhere in here during the trade. You get up here, you're just not going to happen, right? The the way that this develops is it kind of goes like this, right? And then delta flattens out up here. So unless you're down in this range, there are probably not going to be any up adjustments. And the other dynamic you have to look at is, well, I entered it this way because I didn't want to have a problem to the downside. But if you say, well, I'm going to up adjust it, well, if you up adjust it, you're going to create a problem to the downside. So, in other words, a lot of people, especially new people, will look at this completely statically. They're like, this is my entry. I have no risk, right? And this one here is actually a little more risk than what you might see normally. But it's like, oh, I have no risk. But it's not true. It's not true for two reasons. Number one is a lot of the times, or depending on the IV shift, when the market actually does come down, in other words, I could be in this position here, depending on, it's not so common since COVID, because if you were to look at a standard butterfly in the SPX that's say 70 points wide, like the V22, the expiration tent peaks out way behind the position, right? So if I was to just jump into this, and actually it might not show it here because I'm so far behind the market, but it might. That's a 60 point. Look how far back our peak of our T plus zero line is. Weird. Like if you went into 2017, you'd never see that. You went to 2010, you wouldn't see that. You went to 2008, you wouldn't see that. You just don't see it. So we're getting this weird vertical IV skew curve, and it may stay, who knows, forever. You never know, right? Things may change, and maybe that's a permanent change to the market. But historically, we have this very weird vertical IV skew setup where our T plus zero line peaks out way the heck back here, and that's hundreds of points behind the market, which is already hundreds of points behind the market. Just keep in mind that that's unusual, right? So we have that going on also right now in the current environment. Is it going to stay that way? I don't know. But one of the reasons we can even get away with the pricing being the same below the market like that is because of this strange or unusual setup. So let me go here. But my point is, how am I going to make money? Especially if this is a little more expensive and it ends up being maybe a little bit further down. Under most conditions, if you want to make money here, you have to up adjust. And once I up adjust, now I'm starting vulnerability, right? And we had these, and Stephen talks about the old trade that they used to trade. That had like multiple, it's the same concept where you don't want to draw down if you get your down move, your initial down move. And it had this thing where, you would enter, and yeah, the long's worth the money, and that's fine. But you would enter like an eighth of the trade, and then you go another week, you do enter another eighth of the trade, and you go another week, you enter another eighth of the trade. So you're basically running 12 trades at one time, right? Or 8 trades at one time, or even more than that at times. And as the market goes up, this starts out with like no risk, but as the market goes up, you got to up adjust, right? If you want to make that section of the trade to make money. So they would up adjust that, and then it would kind of go flat because it wouldn't be worth up adjusting anymore. And then of course, I mean, you don't know where the segments are going to be. If the market's going up, the segments are one after the other going up. If the market's going down, the segments get one after the other market going down. But if you're thinking that statically, you're like, oh boy, and you're looking at your T plus zero line, you're like, oh boy, this trade can't lose, right? But the problem is twofold. Number one is they make an up adjustment, and that makes the segment vulnerable to a down move. Number two is when the market is uptrending, implied volatility structure is relatively low with a smile, meaning you have to go in a configuration in order to get no upside risk at a greater and greater shorter front wing versus the back wing. And then they're adjusting it upwing towards the back wing. And in other words, as you're trading, you're scaling in and you're continually adding, as you're going on, more and more down risk. And you're also doing it here. Like your biggest volatility impact on this is going to be here. Like if I'm up here and the market, and I get a big volatility shift, this line goes like this. It just comes right out. So and if you're here and you get a down move, you're just right. That's what tends to happen with this. And like I said, with the trade, before Volmageddon, we were getting this constant uptrending market, we had shorter than normal front wings and back wings, fully scaled in, adjusting up so that we were getting a IV rise as the market was going up. So as right, like this is not a solid line. This is a variable line. So you can't take it for what it is. Right. You have to realize if you go down here, it's like this. You have to realize if I get a big up move with an IV that doesn't drop, this is going to drop. Right. So there's multiple scenarios or situations where this can go up and drop and this can go down and drop. It may happen, it may not, but it happens, right? And then of course with that trade, because of the volatility situation, you had shorter than normal front wings versus the back wings, and they had to do um, larger than normal up adjustments, not to draw down with the up move. Because even though the expiration line was here, the T+0 line's sinking, right? So now they got this thing cranked way up with all the risks down, and then Volmageddon, what we call Volmageddon which was the most severe volatility shift we've seen in history, even bigger than COVID. And that ended up, these people just got crushed, right? It just got crushed. T+0 line sank down to nothing, and they had the forced out and got hammered, right? So that dynamic can happen, and you should be aware that that can happen. Most of the time it doesn't, but sometimes it does, right? And when it does, you're likely to experience a much larger loss than normal. So let's talk about losses. Let's go back to gains again, right? So it comes back to what are you going to do to gain money?